April 15, 2016, when the world's sixth-largest container carrier sent a terse, three-line notice to its customers that it could no longer honor any new bookings. The ripple was felt on every dock, in every warehouse, and on thousands of ships that suddenly became floating prisons of cargo worth billions of dollars. Hanjin Shipping, once the pride of South Korea's post-war miracle, had risen from a modest freight forwarder in 1949 to a global behemoth that owned more than 140 vessels and commanded a network stretching from the ports of Busan to the warehouses of Los Angeles. Its emblem, a bold, stylized H, became synonymous with reliability, and its name was etched on the hulls of ships that carried everything from smartphones to soybeans across the world's busiest lanes. The story of that ascent is a tale of ambition meeting opportunity. In the 1970s, as the world's trade routes expanded, Hanjin seized the chance to charter its first container ship, a modest 5,000 TEU vessel that slipped into the seas with a cargo of textiles bound for Europe. By the 1990s, the company had embraced the container revolution, investing heavily in ultra-large ships and sophisticated logistics software. Its aggressive expansion was fueled by low interest rates and a booming global economy, allowing Hanjin to secure contracts with the world's leading retailers and manufacturers. The company's fleet grew at an exponential rate, and its stock price surged, turning Hanjin into a darling of Korean investors and a benchmark for the nation's maritime might. But beneath the gleaming hulls and soaring profits, warning signs began to surface. In the early 2000s, the shipping industry entered a period of overcapacity as rivals rushed to match Hanjin's rapid growth. The market became saturated with empty slots, and freight rates plummeted. Hanjin's aggressive financing strategy, relying on short-term loans and high-interest debt to fund new vessels, left it vulnerable to any downturn. Analysts noted that the company's debt-to-equity ratio had ballooned to over 250%, a figure that would later prove catastrophic. The global financial crisis of 2008 amplified those pressures. While many carriers cut back, Hanjin continued to place orders for mega-container ships, betting on a swift recovery. The gamble paid off temporarily. Demand surged in the early 2010s as China's manufacturing boom drove unprecedented volumes. Yet the boom was short-lived. By 2014, a slowdown in Chinese exports, combined with the rise of protectionist policies in the United States and Europe, caused freight rates to tumble once more. Hanjin's cash flow sputtered, and the company began postponing payments to shipyards and lenders. Insiders recall the first concrete red flags. In late 2015, Hanjin's board approved a restructuring plan that was never filed, and senior executives started meeting with creditors behind closed doors. Rumors swirled that the company had missed interest payments on several of its floating loans that were secured not by land assets, but by the very ships that were now at sea. Port authorities in major hubs like Singapore and Rotterdam started flagging Hanjin containers for inspection, fearing that the cargo could become a legal quagmire if the carrier defaulted. Then, on February 8, 2016, the inevitable happened. Hanjin announced that it would file for creditor protection in the United States, a move that sent shockwaves through the supply chain. Within weeks, dozens of its vessels were anchored off the coasts of Asia, Europe, and the Americas, their decks piled high with goods ranging from luxury watches to essential medical supplies. In the Philippines, a container ship sat idle for months, its crew living in cramped quarters while the cargo, cameras, furniture, even a shipment of fresh produce, began to spoil. In the United Kingdom, a Hanjin-operated vessel was forced to dock with its hatch covers welded shut, a desperate attempt to prevent looters from taking the abandoned cargo. The collapse left more than $7 billion in cargo stranded, a figure that dwarfs the combined losses of many other maritime failures. Shippers scrambled to find alternative carriers. incurring hefty surcharges and facing weeks of delays that rippled through retail shelves and factory floors worldwide. The financial fallout was immediate. Hanjin's stock plummeted to a fraction of its former value, and creditors, including banks, shipbuilders, and even smaller freight forwarders, found themselves entangled in a labyrinth of legal disputes. The South Korean government, which had previously lauded Hanjin as a national champion, was forced to intervene, offering emergency financing to keep some of the stranded vessels from being seized outright. In the months that followed, the industry watched as Hanjin's assets were sold off in a series of fire sale auctions. Its flagship vessel, the 20,000 TEU Hyundai Fortune, was acquired by a rival consortium and renamed, while the remaining fleet was divided among creditors, each hoping to recoup a fraction of the losses. The human cost was equally stark. Thousands of seafarers found themselves unemployed or stuck on ships with uncertain futures, and countless small businesses that relied on Hanjin's routes faced bankruptcy. The aftermath reshaped global shipping in profound ways. Regulators tightened oversight of carrier solvency, introducing stricter reporting requirements and encouraging the adoption of financial safety nets such as maritime insurance pools. Companies began to diversify their logistics chains, avoiding single carrier dependence, a lesson painfully learned from Hanjin's downfall. Meanwhile, the industry's consolidation accelerated as larger, financially robust carriers absorbed the market share left behind, leading to an even more concentrated landscape. Today, the ghost of Hanjin's once towering crane still looms over the port of Busan, a reminder of how swiftly a titan can crumble when ambition outpaces prudence. Subscribe to The Collapse for more stories like this.